Hi, you're American, or you're not, but you still feel its effects every time you check a stock app, complain about gas prices, or watch your country's currency move because some guy in Washington said 5 words about interest rates. That's the deal with the U.S. economy. It doesn't just run America, it kind of runs the planet's economic weather. So let's speedrun the whole thing, how it actually works, the mechanics, the money, the markets, in the next 20 minutes. Let's start with the actual foundation, the stuff every economics course begins with, because none of the rest makes sense without it. You want stuff, food, rent, a phone that doesn't crack the second it touches the floor. The problem is, there's never enough of everything for everyone. That's scarcity, and it's the entire reason economics exists. If there were infinite pizza, infinite apartments, infinite everything, you wouldn't need a single econ class. But there isn't, so we have to choose, and every choice means giving something else up. That's opportunity cost. Skip your shift to study for finals, and the wage you didn't earn is the cost of that A. Scarcity is also why we trade. You're good at writing essays, your roommate's good at fixing code, you swap help, and you're both better off. That's comparative advantage, being relatively better at one thing, even if someone else is better at everything. It's the entire logic behind why people specialize in jobs instead of everyone growing their own food and fixing their own laptops. Put a bunch of buyers and sellers trading like this in one place, and you get a market, and the whole thing runs on incentives. Raise the price of something, and people want to sell more of it and buy less. Lower the price, and the opposite happens. That tug of war between buyers and sellers is supply and demand, and wherever the two sides agree on a number, that's the equilibrium price. Mess with that number directly, price caps, price floors, and you usually just create shortages or surpluses instead of actually fixing anything. That's the toolkit: scarcity, choice, trade, comparative advantage, markets, incentives, supply and demand. Every single thing from here forward is just this toolkit applied to a $27 trillion economy. Start with the basics. America runs on capitalism, private property, free markets, profit motive. You want to sell hot sauce, sneakers, or NFTs of your dog? You can just do that, risk it, and if you win, you keep the upside. Lose, and there's a reason ramen is basically the unofficial currency of every college dorm in the country. But pure capitalism, with zero rules, turns into chaos with extra steps, so the government adds some. Antitrust laws stop one company from owning everything. Labor laws stop your boss from working you 90 hours a week for a granola bar and a good vibes Slack emoji. This blend, mostly free markets with a government referee, is called a mixed economy. Despite what your uncle insists at Thanksgiving, America has basically always been one. So how big is this thing actually? The U.S. economy is the largest in the world by GDP, gross domestic product, the total value of every final good and service produced in a year. We're talking about $27 trillion and counting. Break it down, and almost 70% of that is just people buying stuff. You, scrolling Amazon at 1 a.m., that's consumer spending, and it's basically the engine of the entire system. Add in business investment, government spending, plus exports minus imports, and you get the full GDP equation. The catch: GDP doesn't measure whether you're actually happy. It doesn't count unpaid labor, and it definitely doesn't care that your rent ate half your paycheck. It just measures size, like an economic bicep curl with zero regard for cardio. Who controls the money? The Federal Reserve, the Fed, America's central bank, created in 1913 after a string of bank panics convinced everyone that leaving money to total chaos was a bad plan. The Fed does two big jobs. 1. Set interest rates, the cost of borrowing. 2. Control the money supply. Economies overheating, prices climbing too fast, raise rates, borrowing gets expensive, spending cools down. Economies sluggish, cut rates, borrowing gets cheap, spending heats back up. It's basically a thermostat for the entire country, except instead of a dial, it's 8 people in suits at a podium, and the stock market has a small seizure every time one of them clears their throat. When rate cuts alone aren't enough, the Fed pulls out quantitative easing, buying government bonds to pump money directly into the system. Critics call it printing money with extra steps. Defenders call it crisis management. Either way, it's why your professor says 2008 and 2020 in the same breath like they're trauma flashbacks. One more wrinkle: the Fed is supposed to be politically independent, making decisions based on data, not elections. In practice, presidents lean on it constantly, because nothing tanks a re-election campaign faster than a recession. Whoever sits in the Oval Office gets to nominate the Fed chair, who then has to survive Senate confirmation and roughly 4 years of public pressure to just lower rates already. The Fed mostly resists because once people stop trusting it to actually fight inflation, the whole system gets shakier. Independent on paper, constant political side-eye in practice. Where does the actual cash come from day to day? Mostly loans. Your roommate's car loan? New money. Someone's mortgage? New money. Banks don't keep your deposit locked in a vault like a movie villain. They hold a small reserve and lend out the rest. That's fractional reserve banking, and it's why bank runs are dangerous. If everyone wants their money back at once, there isn't enough physically there. That's why the FDIC insures deposits up to $250,000, so your bank collapsing doesn't mean your life savings vanish into a spreadsheet error. Now, the dollar itself. It's not just America's currency, it's basically the world's. Around 90% of global currency trades involve the U.S. dollar. Oil gets priced in dollars. Central banks worldwide stockpile dollars, like doomsday preppers stockpile canned beans. That's reserve currency status. And it means the U.S. can borrow money more cheaply than literally any other country, because the entire planet wants dollars, regardless of what Washington is doing that week. It's an absurd cheat code, and it's a massive reason America can run up debt that would sink anyone else. Quick bit of context. Since the title does say U.S., this system didn't appear overnight. A 1913 banking crisis is what led Congress to create that central bank in the first place. The 1929 crash and the Great Depression that followed added deposit insurance, Social Security, and serious financial regulation. Decades of policy since then have swung between heavy regulation and heavy deregulation through stagflation in the 70s, deregulation in the 80s, and crises in 2008 and 2020 that rewrote the rulebook all over again. That's the entire history lesson you're getting today. Everything from here is how the machine actually runs right now. Speaking of debt, let's go to Washington. The federal government spends roughly $6 trillion a year. Defense, healthcare, infrastructure, interest payments, and yes, farm subsidies you'll never personally benefit from. It gets that money mostly from taxes. Income tax takes a slice of your paycheck, and it's progressive. The more you earn, the higher percentage you owe, at least on paper. Payroll tax, FICA, funds Social Security and Medicare, and it disappears from your check before you even see it, which is why your first real paycheck always feels like a small betrayal. Corporate tax hits company profits. Capital gains tax hits money made from investments, and it's famously lower than income tax, which is why wealthy people prefer making money from money instead of, working a job. When spending outpaces taxes, that's a budget deficit, and the U.S. has run one almost every year for decades. To cover it, the Treasury issues bonds, essentially IOUs that say lend us money now, we'll pay you back later with interest. Stack up every year's deficit, and you get the national debt, which just blew past $34 trillion, a number so large it stops meaning anything, kind of like trying to picture a trillion grains of sand, or checking your student loan balance after 4 years of deferred interest. Is that bad? Depends who you ask. Debt funding productive stuff. Infrastructure, research tends to pay for itself over time. Debt funding pure short-term spending, less so. What actually matters is whether the debt grows faster than the economy itself. Right now, most economists are worried but not panicking, which in economist language means quietly panicking with a calm face on TV. And here's the uniquely American twist. Even after Congress approves spending, it then has to vote again just to let the Treasury actually pay for it. That's the debt ceiling, a legal cap on how much the government's allowed to borrow. Every couple of years, Congress flirts with not raising it, threatening a default, a market panic, and a credit downgrade, before voting yes at the literal last possible minute. It's like setting yourself a deadline and then sprinting to the gate every single time, except the gate is the global financial system. Now let's talk about where Americans actually try to grow money. Wall Street, shorthand for U.S. Financial markets, anchored by the New York Stock Exchange and the NASDAQ. When the news mentions the Dow Jones or the S&P 500, those are indexes, basically scoreboards tracking how a basket of big companies is doing overall. Buy a stock, you own a tiny slice of a company. Company does well, your slice is worth more. Company tanks, well, that's why financial advisors love the phrase long-term investing, which really just means, please, for the love of God, don't check your 401k during a crash. Most Americans don't pick individual stocks. They invest through retirement accounts, a 401k through an employer, or an IRA on their own, often into index funds that just buy a little of everything at once. Less exciting than day trading on an app between classes, sure, but also far less likely to end with you eating ramen for emotional support. Then there's crypto, America's favorite financial chaos pet. Bitcoin, Ethereum, and 1,000 coins you've never heard of trade 24/7 with basically none of the rules that govern actual stocks. The SEC, the agency that regulates securities, has spent years arguing with the entire crypto industry over whether these coins even count as securities in the first place. Depending who you ask, crypto is the future of money, a Ponzi scheme with a slicker website, or just an extremely expensive way to lose your rent money on a coin shaped like a dog. Sometimes markets break completely, which brings us back to 2008. Banks had bundled risky mortgages into investments everyone pretended were safe. They weren't. Housing prices crashed, banks collapsed, and the whole economy got dragged into the worst recession since the Great Depression. It took a massive government bailout and years to climb back out. And yes, that's the same 2008 your econ professor mentions like it personally wronged them. Now let's talk about the companies basically running your life. Apple, Amazon, Google, Meta, Microsoft. A handful of tech giants now make up a huge chunk of the entire stock market's total value. They're so dominant that regulators keep filing antitrust cases, lawsuits arguing they've grown so big they're crushing competition before it can even start. So far, the tech giants mostly keep winning, partly because by the time a lawsuit wraps up, the company being sued has already bought, copied, or out-innovated whoever was supposed to be the cautionary example. Before those giants were giants, most of them went through Silicon Valley's other engine, venture capital. It's an entire ecosystem built around funding risky startups in exchange for equity, betting that one unicorn, a startup worth over $1 billion, will make up for the 9 others that flame out spectacularly. It's why a 23-year-old with a laptop and a pitch deck can raise millions before ever turning a profit, and why "we're not profitable yet" became an acceptable answer instead of a giant red flag. This system built Google, Facebook, and Uber. It also built a few hundred apps for ordering artisanal toast that quietly died within 18 months. That kind of concentration feeds straight into inequality. The top 1% in America hold more wealth than the bottom 90% combined. CEO pay has exploded relative to average worker pay, thanks largely to stock options and a labor market where workers lost a lot of their bargaining power over the decades. Which brings us to unions. Membership's been shrinking for years, hit by outsourcing, anti-union laws, and waves of automation. But you've probably noticed the recent pushback. Starbucks baristas, Amazon warehouse workers, auto workers, all organizing again, betting the pendulum might finally swing back. Speaking of work, let's talk wages. The federal minimum wage has been frozen at $7.25 an hour since 2009, though plenty of states and cities set their own, way higher. Then there's the gig economy. Uber, DoorDash, Instacart, an entire shadow labor market where you're technically your own boss and definitely don't get benefits. It's flexible. It's also why side hustle became a full personality trait for an entire generation. One more piece of the labor puzzle: immigration. Immigrants make up roughly 1/6 of the entire U.S. labor force, filling everything from Silicon Valley engineering teams to construction crews to the seasonal farm work that keeps grocery store produce sections stocked. Most economists agree immigration grows the overall economy and fills labor shortages that would otherwise go unfilled, though the political debate around it rarely sounds anything like an economics lecture. Either way, GDP doesn't check anyone's passport before counting their output. There's also automation quietly reshaping all of this from underneath. Robots, software, and increasingly AI are taking over tasks across factories, warehouses, and now office jobs too. Economists call the upside productivity growth, more output per worker, which historically makes everyone richer over time. The downside is that the transition rarely feels great if you happen to be the one getting automated out of a paycheck. Now, the part that hits closest to home if you're watching this from a dorm room: student debt. Over $1.7 trillion in outstanding student loans spread across more than 40 million Americans. College tuition has risen way faster than inflation for decades, partly because schools compete on amenities like rock climbing walls and lazy rivers, partly because easy federal loans let schools charge more, which made students borrow even more. It's a feedback loop, and right now, you're standing inside it. Americans also love spending money they don't technically have. Credit card debt nationwide just topped $1 trillion, and buy now, pay later apps turned splitting a hoodie into 4 payments into a national pastime. Then there's Black Friday, the unofficial holiday where the entire country sprints into stores the day after giving thanks for everything they already own, just to buy more of it at a discount. Retail spending alone makes up a massive chunk of the consumer spending number we talked about earlier, which means, in a very real sense, your questionable Amazon cart is technically doing its patriotic duty. While we're on money you don't have, let's talk healthcare, because America does it weird. Most working-age people get insurance through their employer. Everyone else either buys it through the Affordable Care Act marketplace, qualifies for Medicaid if they're low income, or gets Medicare once they hit 65. It's the only wealthy country without universal health care, and the result is the most expensive healthcare system on earth, with outcomes that don't really match the price tag. Go to the ER without insurance, and you might leave with a bill that looks like a phone number, area code included. Even with insurance, a single hospital stay can blow past your deductible before you've even finished the complimentary Jell-O. Now, housing. Mortgage rates are heavily shaped by the Fed's interest rate decisions, so when rates spike, monthly payments spike right with them, pricing out millions of would-be buyers overnight. Add decades of restrictive zoning blocking new construction in most cities, and you get a housing shortage so severe that starter home has basically become a myth, like Bigfoot, or finding parking near campus on a home football weekend. Zoom out geographically, and the picture gets even messier. The Rust Belt, once the heart of American manufacturing, Detroit, Pittsburgh, Cleveland, lost millions of jobs to automation and outsourcing starting in the 70s and never fully recovered. Meanwhile, the Sun Belt, Texas, Florida, Arizona boomed on cheaper housing, lower taxes, and better weather. And tucked into Northern California, the San Francisco Bay Area produces a wildly disproportionate share of the country's entire tech wealth, all while having some of the worst housing affordability on the planet. Same country, wildly different economic universe, depending entirely on the zip code. Let's go global. The U.S. runs a massive trade deficit, importing way more than it exports, especially from China. For decades, the policy was free trade, lower tariffs, more imports, cheaper goods at Walmart and Target. Then came a pivot. Tariffs on Chinese goods, attempts to bring manufacturing back home, and a supply chain panic after COVID showed everyone exactly what happens when your toilet paper supply depends on a single container ship stuck somewhere in the Pacific. Now trade policy in Washington is basically a permanent tug of war between cheap imports and economic independence. On top of that global picture, there's the neighborhood version, NAFTA, later replaced by USMCA, ties the U.S. economy tightly to Canada and Mexico, with car parts, produce, and entire supply chains crossing those borders multiple times before a finished product ever lands on a store shelf. Deeply unglamorous, and also genuinely massive, accounting for trillions of dollars in trade every single year. Which brings us to inflation, the word that wrecked everyone's grocery budget starting in 2021. COVID stimulus checks, snarled supply chains, and a wave of pent-up demand collided all at once, and prices hit the highest levels in 40 years. The Fed responded with the most aggressive series of rate hikes in decades, slowly choking inflation back down, while everyone complained that eggs suddenly cost more than their entire childhood allowance combined. So, step back, what's the actual takeaway? The U.S. economy is the largest on the planet, built on capitalism, propped up by the dollar's global dominance, steered by the Federal Reserve, funded through taxes, invested through Wall Street, increasingly dominated by a handful of tech giants, strained by inequality and student debt, and occasionally blindsided by its own mistakes, 2008 being Exhibit A, 2020 being Exhibit B. It's chaotic, it's contradictory, it argues with itself constantly, and somehow it still produces about a quarter of all global economic output. So what have we actually learned? Capitalism with a referee, a central bank quietly running the thermostat, a dollar the entire planet depends on whether it likes it or not, a government that taxes, spends, and somehow still runs a deficit nearly every year anyway. A stock market most people barely understand, but everyone's retirement depends on regardless. A handful of tech giants quietly owning more of the economy every single year. A labor market caught between unions trying to make a comeback and gig apps trying to replace them entirely. A college system that traded affordability for amenities. A housing market that's gotten harder to enter every year you've been alive. And a Fed constantly fighting to keep inflation from turning a grocery run into a full hostage negotiation. That's all of U.S. economics, more or less, explained fast. If this helped you survive your econ final, understand why your paycheck feels like a magic trick, or finally explain to your parents what you're actually studying, you know what to do. Hit like, or the algorithm personally declares a recession on this channel.